Okay, so team, Sidin meet Ernest. Ernest is in Kasama. Sidin is in the capital city of Lusaka. So today marks the first day of our long, short journey. Why I'm calling it long, short journey is that you'll be writing your exams next month. So meaning that it's short, but it's going to be long because we need to do a lot of work together. We might be meeting almost every day, and I'll be giving you a lot of work. That is how it's going to go like. You need to find time to go to our website, royconsultadvisory.com. Register there. I'll have a specific page for financial reporting where I'll be posting works, puzzles, quiz. It will be posted on that website. I had gone into retirement, so Sidin decided to fish me out from retirement. I've been in this business of lecturing for so many years. But then I said, I think I've made all those people that needed to pass, they have passed. They are now done with their qualifications, with their programs. So why should I continue? So I'd stopped. So I've started today and with a bang. So we'll start with conceptual framework. That is what we're going to start with. For us to understand financial reporting, we should understand what are these underlying concepts that we can use to understand financial reporting. Your aim is not just to pass your exams. Your aim is to understand these concepts so that you can fully use them in your career. I think where we normally miss it as students is that we focus so much on passing rather than on knowing things. Yes, you pass because you have regurgitated so much information, you have memorized so much information, you can pass. It is possible to pass. Ideally, passing is not a very difficult concept because you just have to be half ignorant to pass your professional exams. If you don't know about 50% of what is needed to be known, and you only know 50% of that, you still pass. So passing professional exams requires you to be semi-ignorant. You have heard what he did. Okay, so now we can start. We look at conceptual and regulatory framework. Initially, the conceptual framework for financial reporting was developed or published in 2010. It took about 8 years for the framework to be revised. So for those companies that use the conceptual framework to develop accounting policies, when you know IFRS standard applies to a particular transaction, the revised conceptual framework is effective for annual reporting periods beginning on or after 1st January 2020. So it is already it is effective. So it has already been effected. So I'd already mentioned where this particular standard comes from. It was first issued in 2010, specifically in September, and revised in 2018, and then effected in 2020. So when you're given a question on conceptual framework, I would suggest that first you give a brief of what this conceptual framework is and when it was issued and the revised period. Just to give a context, we call it, it is more or less like it is an icebreaker of some kind, but the examiner can give you a mark. So what does the 2018 revised conceptual framework sets out? The first thing is that the objective of general purpose reporting all you are doing, you are giving this information for the users of accounting information to use it in an informal way, maybe, yes. But the most important thing, for them to make an economic decision. If it is employees, you're giving them this accounting information to decide whether they should continue being with you or they can now start looking for greener pastures, as they call it. If it is for unionists, once you give them this information, they have to decide whether to press you hard for their salary increment or to press hard for you as management to be chucked out. For the lenders, it is just important that the lenders, they have access to this accounting information. For your own information, Sidin and Ernest, the lenders have even gone beyond asking for accounting information, meaning these financial statements. They are actually requesting that companies can provide what they call integrated reports. These integrated reports, they do not only just focus on the financial information, they also look at other aspects of the business. How are you as a company interacting with the environment? How are you building relationships with the communities? So it looks at 6 capitals. And at some point, I'll explain what integrated reporting is, but not for this particular topic. So the lenders, they would want to see lenders, both lenders, existing lenders and would-be lenders. For existing lenders, for them, it is a must that they need to pay a particular, they need to put you under surveillance as a company because they have invested in your company. Their money is in your company, which you are calling as liability or as debt or as interest-bearing debt. So they'll be monitoring. They have their own tools which they actually use when they get these financial statements sitting. They have their own tools which they use to check whether their investment is still very safe. They even come up with some methodology of some kind, some systems or mechanism, not really methodologies, but mechanism, which safeguards them. I'll give an example of senior lenders. The senior lenders, they are given preferential treatment. You have senior lenders, you have the junior lenders, or what you call mezzanines. So with the senior lenders, they'll get their interest first, they'll get the principal repayment first, meaning that the debt service, first you have to service the senior lenders before you go to the other lenders. But they are very smart. They'll push in certain things, such as they'll be monitoring the debt service coverage ratio, for example. If the debt service coverage ratio goes beyond, or should I say goes below what has been agreed upon, they can start locking your earnings, your EBITDA, so that before you use it for other things, it just goes straight into their debt service reserve account. So they have all these mechanisms that they can use to safeguard their investments. And this is the reason why they need to have access to this accounting information. And in the framework, we are calling it the objective of general purpose reporting. Ernest, are you getting me? Ernest is very quiet. Maybe he doesn't even know where to unmute. Guys, we have to make the class very interesting. So once in a while, Sidney, you unmute and you say whatever you have to say. Yeah, the one.
I'm getting it.
Yeah, you are?
Coming out nice.
Okay.
Yes, yes.
Okay. Mm-hmm.
Yeah.
At least you have fished me out of retirement, so it should make a bit of some noise. Yeah. Then, the other thing that the conceptual framework sets out, the qualitative characteristics of useful information. I know we'll be looking at the fundamental characteristics of this particular information later in the presentation. But we need to know, what are these characteristics of good information? Those days, I remember a long time ago, we used to call it accurate. Accurate as an acronym. Accurate as information has to be accurate. Information has to be cost effective. We used to go on like that, but I know we'll condense them in this particular lecture. But there is need for good information, because information which is not good, it will be very difficult to trust. And once it is not trustable information, you as an organization, for example, for the potential lenders, they will not give you the money because they don't trust what you have put in your financial statements. So this is why it is important that the information that is contained in your financial document should actually be that of good quality, which we'll be looking at. A description of the reporting entity and its boundary. There should be some description of some kind. What is this reporting? What is this particular department, organization? In which business does it deal in? I know tomorrow, before we even go to group accounts, we will need to actually, I'll give you access to an audited financial statements for some Googled company, so that we check, say for example, for Netflix, maybe we'll use Netflix, maybe we'll use some other, these companies that you know, those that are already on the stock exchange, so that we check what are these things that they are looking at. The moment these lectures become practical to you, it becomes easier to assimilate. You stop reading a lot. So it should actually show what this entity is, what is its principal activities. That is very important. The scope of the company, what does it deal in? There should be a definition of an asset, a liability, equity, income, and expenses, and guidance supporting these definitions, which we'll be looking at. But for your own information, we know that assets, anything that is of value is an asset. Anything that is of value is an asset. So it depends. Is this asset long-term? Is this asset short-term? Then now you move on to start looking at whether it's non-current asset or a current asset. Or as old school would say, fixed asset or current asset. So we'll be looking at all those things. It also sets us the criteria for including assets and liabilities in financial statements. At what point do you recognize the liabilities? At what point do you recognize the assets? And when you recognize the assets, are you able to measure them? What you cannot measure cannot actually sit in the financial statement because it will be very impossible for you to have it there. So you should be able to measure it. It should be costed. So what measurement basis are you using? And guidance on when to use them. That is what this particular framework looks at. Concepts and guidance. Concepts relating to capital and capital maintenance, which we'll be looking at, guys. So now we look at the International Accounting Standards Board. International Accounting Standards Board, Conceptual Framework. So let's look at the IASB framework. It provides the underlying rules, conventions, and definitions. It acts like the way your constitution acts. Your constitution gives you these rules, underlying rules. What to do and not what to do. How you can be a very good citizen. Basically, that's what your constitution does look at. So a conceptual framework is more or less like a constitution for accountants. And this is what we have to follow as we prepare financial reports. Remember, it's not management accounting where you can prepare whichever way you feel like. There's some rules that we have to follow or we have to abide to. There are some rules that we have to abide to. So what does this conceptual framework aim to achieve? One, it ensures the standards developed within a conceptual framework, that all these standards that we have, when we talk about IFRS 16 leases, we go to IAS 36 on impairment, they have been guided by this framework. So all these standards are framed or developed using the conceptual framework. So it's more or less like a guiding angel that whatever you want to develop, it should be within this particular framework. So it does not only look at new standards, how these standards are supposed to be developed, but it also looks at the existing standards on how best they can be improved. Time and again, these standards sometimes fail us. This world is, as much as it is endowed with very stupid people, but it is highly endowed with extremely smart people. But these smart people, sometimes they don't use their smartness for the good of the society that they live in. They use that smartness to manipulate these systems for their own good, to manipulate the standards because they have found a loophole, and they'll magnify that loophole and use it to enrich themselves. We saw what was happening with Bernard Madoff and all these other extremely gifted people, but acting as bad guys. So these standards, each time there's a scandal, IASB or governments, they find an opportunity of strengthening their local standards, which maybe eventually can affect these global standards, accounting standards. So it aids the process to improve existing standards. Thirdly, ensures financial statements contain information that is useful to users. It does not make sense to include information that cannot be used. You need the usable information in your accounting statements, in your accounting documents. So this framework, it actually helps the developers of these financial accountant, the developers of these financial statements to look at, to focus, and only provide that information which is useful to the diverse users of accounting information. I had already mentioned about Bernard Madoff. You remember Enron, Parmalat scandals. So these standards, they are there to help prevent creative accounting. Sidin, let me see you some and say something.
I'm grateful because I can see that the things are now flowing.
Mm-hmm.
Because eventually, at the moment, we were just looking at a conceptual framework.
Yeah.
You move to what is important. But now the way you are coming out, it's very clear that we understand where they are coming from. And I can even now issue statements based on the conceptual framework, you know? Yeah.
So always when you look at it,
No, it's making
it does make sense. I hope it does. And get used to the way I lecture. I use what we call memory pegging and mind mapping. You memory peg, for example, if I'm saying something about global, I would give you maybe a story of one of the prominent politicians, Mr. Shimbakambwili, Dr. Shimbakambwili. So the moment you see the term global, you think about him because he used to talk about global, 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 global. Then answers now start coming in. They call it memory pegging. You need to find something that is closer to you, something that you can associate with, so that you memory peg. Even when you go into the exam, you don't need to start thinking a lot of things because whatever question you see, you are able to memory peg and write nicely. So as we move on, you'll see this technique of memory pegging. And here you can memory peg a constitution. So the constitution, if you have to look at the first point, we are saying ensure standards developed within a conceptual framework. We are actually saying citizens have to behave in a certain way. So the constitution helps you to develop in a certain way. Without a constitution, then you have the right to behave in whichever way. Without having religious principles of some kind, religion, whichever way you look at it about religion, it helps you to behave like what that religion expects you to behave. If I go for Islam, that religion expects me to behave like the way a Muslim is supposed to behave. If I go into Christianity, that religion helps me to behave in the way a Christian behaves. So if I behave in a different way, they'll say, we thought he was a Christian. He's all the time he goes to church, but just see the way he's behaving. He behaves like he's from this particular sector or sect. So you're memory pegging. Even when you look at the Constitution itself, it helps us to behave in the way we should behave. But it also puts in provisions on how it can be amended. And this is why I'm saying aids the process to improve existing standards on how it can be amended. So the Constitution will say this is how you should behave. But this Constitution will put in on how best you can amend yourselves. You can amend it. So basically, that's what it is. You have to memory peg. So it helps prevent creative accounting. But like I said, this world is endowed with extremely intelligent people who do not use their intelligence for the good of society. They will always beat these standards. And it is the job of the International Accounting Standards Board to develop, to improve, to strengthen these standards so that these standards can continue serving its purposes. So we now look at the objective of financial reporting. What is the objective of financial reporting? I had already mentioned on the first part, Ernest, I'd already mentioned that users of accounting information would want to use the accounting information for their own selfish motive. The investors would want to see whether their investment is still secure. There's maximization of shareholders' wealth, and they'll have to make a decision whether to sell a part of their shares stake, to sell all their stake, to fire the board of directors. They'll have to make those decisions. It is based on the accounting information. So that is the first thing. And I'm saying it is more of selfish interest. They are actually looking at they themselves. An employee will use this accounting information to decide whether he has to do a squale to leave the company and go, because he doesn't want or she doesn't want to find herself in a position where the company has crumbled and cannot get anything. And we have seen these things happening. We have seen them happening. Even when we were young, our parents, our aunties, our uncles, our grandfathers lost a lot of chunk in Meridian Bank. So we have seen these things happening. So if there's that sign, maybe it's going to give you some tools. You use that to decide whether to leave or to still continue. Economic resources of the entity. Now, let me go into the IR thing. I've been part of the team that has been preparing integrated reports. Now, this is our 7th year preparing integrated reports for the company that gives me a salary every month. What it is that every organization interacts with what we call 6 capitals. The manufactured capital, these are assets that have been like property, plant, and equipment. Natural capitals, these are gifts of nature, rivers, trees, and all that, which has been manufactured by God, and you're using it as well to extract value. Human capital, which is us, the human beings, working so that we extract value for the shareholders. Intellectual capital, which comes in through research and development and all these other things. Social and relationship capitals, the communities that you are in, how are you serving those communities? So all these 6 capitals, they have to be used. They have to be used to extract value. That value is basically the economic value. So we are looking at economic resources of the entity. The shareholders sitting.
Maybe can come again. I just captured the intellectual capital, human capital, then the social part of the aspects. The first and the
Okay, on the IR, isn't it?
Yes, on the IRS, yes.
So I mentioned there's financial capital. Did I mention the financial capital? Just tell me the capitals I mentioned.
You told me intellectual capital, human capital, then the social aspect in terms of the communities where we are found, the impact that we are creating, yeah. Then the financial. So I'm remaining with 2 now.
Okay, so I did mention about the first. Let's start manufactured capital.
Okay.
Natural capital.
Yes.
intellectual capital,
Yes.
human capital.
Sure.
Then we have social and relationship capital. Which other
Yeah.
one? Which other one? I've
You
mentioned.
mentioned financial, then manufactured capital, natural capital, intellectual, human, social, and relationship. I think we are 6 now.
Yeah. So all those capitals, they'll have to be used to extract economic value. Those days, we used to focus on financial. But this time now, you have to look at all these capitals and see how best they can be used to extract value. So the objective of financial reporting, it will definitely show you the economic resources of the capital of the entity. If, for example, your retained earnings under equity, it is actually going under, then you are able to see that you have a problem in extracting value. If, for example, your working capital is in negatives, meaning that your assets are much lower, your current assets are lower than your current liabilities, it again shows that you are failing to extract economic value. Remember one thing, there are two investors in any organization, most of the organizations. You have the equity investors. You also have the debt investors. Those that give you money who do not want to be part of your organization, they are lenders. And these lenders, they get dividends, which you call interest. But these dividends for them, they are based on a mathematical computation based on the funds they have provided in that company. Whereas the equity shareholders will be given dividends. But these dividends, it obviously might have a policy, but most of the time, it is actually based on the performance of the company. It would be unethical to give equity shareholders dividends when the company is not doing fine. So you'll be looking at claims against the entity. Obviously, these are liabilities. We'll be looking at changes in the entity's economic resources and claims. Claims, you're actually looking at liabilities, obligations. The economic resources I've already mentioned. This is where you're looking at the equity part, retained earnings, and all these other things that shows whether you are actually increasing your value. So, having looked at the objective of financial reporting and we have explained it, now we look at the underlying assumption. And this underlying assumption, Ernest, is what we call going concern. Going concern is just an assumption that an entity shall continue being in existence for a foreseeable future. This entity, there is no plan whatsoever to curtail production or to cease production or to fully close the company. And how would you know that this company is using a going concern assumption when you look at the balance sheet? It's simple. Without reading what the audit has written, without checking whether this company is a going concern, doing my own analysis, but the assumption that I will see that this company is actually assumed to be a going concern is that they are using a cost model where their property, plant, and equipment is being reduced based on accumulated depreciation. So depreciation gives me a key that this company, these people still think that it's a going concern. Then it will be just up to me after I've analyzed to see whether this company, whether you doubt that assumption that the company is not a going concern. Because if the company decides that it's not a going concern, it will not look at their property, plant, and equipment, less depreciation. It will put all those equipments under IFRS 5, which is assets held for sale. But as long as they are depreciating them, they think that these assets will continue generating value for a foreseeable future. And this is why this assumption is so important. Sidin, are you getting me?
It's making sense because honestly, if you are selling, then it's a different issue. But if you are depreciating, then these activities will continue to generate resources.
It's just for example, how would you know that this person, you as a human being, you are still a going concern? I want to use this as an example which you can use for your memory pegging. Imagine you're in the hospital. You're in the hospital. Me as a person who is just an outsider, looking at your health, I'm thinking that anytime you will be dying. But you, that's when now you're actually paying for tuitions at Harvard University or any other university or Lusaka University. You're paying for tuitions for the following semester. But what does it tell me? It tells me that you are assuming that you're going concern. I don't know if you're getting what I'm saying.
No, I'm getting it.
But for the visitors who are coming into the hospital to see you on your hospital bed, you're seated or whatever in the hospital room, they are just saying, I doubt if this person is going to survive. Why has he been paid for tuition at Harvard University?
Is he going even to fly?
Why is he doing that? You see what I mean? So you as an independent analyst, once you do an analysis, maybe you'll be able to doubt the going concern of the company. But as long as that company has assets in their balance sheet and they are depreciating them, they're assuming that they will continue being in existence for the foreseeable future. So they are still a going concern. And that's where this underlying assumption comes from, guys. This is not theory, this is practical.
Yeah.
And this is what we are saying. An entity is assumed to be a going concern in the absence of significant information to the contrary. And this is why you as a financial expert, you do all these financial ratios and all those to determine, to question this assumption. But an organization has assumed that it is a going concern. Like I'm saying, I'm sick, I'm about to die, and I pay for tuition fees at Harvard University. Even if you see then it comes to see, for you, obviously, you say, this is where now you can say you have significant information to the contrary that I'm not a going concern, anytime I'm dying. I don't know if you're getting me.
No, I'm getting the concept.
The concept, that's where this concept comes from. This is the conceptual framework that you use to build your financial reports. And this topic is so important. Mostly students, they don't know how relevant this topic is. So the contrary information, like I said, for a person like me, who is actually on my deathbed and I'm paying for the future, there will be certain information that you have to check. And this is a job that you are endowed with as financial experts. An example of such contrary information is an entity's inability to meet its obligations as they come due without substantial asset sales or debt restructuring. So without saying, no, I'm going to say this particular building to pay for this loan. If you are not doing that and you're paying all these obligations based on your principal activities, then you're still a going concern. But it doesn't stop you from assuming being a going concern, even when you're actually dying. But someone who will come in will check on all these things and say, I don't think this company is a going concern.
So there is a claim
Yes.
actually by the company to say, I'm okay.
Yes. So it's
That's
up to you who is looking at a distance to say, no, 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 you're not okay. If you're okay, you are not going to sell this asset. You are not going to
pay salaries, you have to borrow.
Now you understand this concept. Always
Sure,
make it with someone who is in the hospital, is sick, and is trying to build their house to do all these other things.
Yeah.
Yeah, thank you, thank you. So now we go to qualitative characteristics. What are these characteristics of good information that make information useful? So first, we'll look at the fundamental qualitative characteristics. One is that this information must be relevant. So information that makes a difference to decisions made by users. By nature and materiality, this information must be relevant, guys. If you give me information that I'm not going to use for decision making, then this information is not relevant to decision making. It's not relevant to me. Why are you giving it to me? Then it means that it does not actually contain the good characteristics of, or it doesn't contain the characteristics of good information. So information has to be relevant. Those days, you remember, we used to come up with an acronym of accurate.
Yeah.
Well, we say this information must be accurate for A. For C, it must be cost effective. And we'll move on like that.
Timely.
Yeah, and all those things. Easy to understand. Second point, other than just this information being relevant, Ernest and Sidin, since you have fished me out of retirement, this information has to be very faithful.
This looks like a new issue. Faithful.
Yes. There is information which might not be very faithful, information which is not complete. So faithful information, it should be complete. It should help you to make informed but economic decision. It helps to understand and include descriptions and explanations. This information must be neutral, no bias, and free from error. I've always said that objectivity is God. It's very difficult for a number of us, as long as we're human beings, to be objective. But let's try to thrive towards objectivity, because God is objective. Objectivity is God. So even when you're looking at this faithful information, all you're saying, when you try to explain what faithful information is this information that is neutral. This information that does not contain any biases of any kind. Most importantly, it is free from error. Because if it contains some bias, then this information is actually inclined to achieve a certain outcome, not based on the principles of truth. And as finance experts, you always need to exercise that independency. You need to actually, and independence is so important because it's objectivity, it's God. When you're objective, trust me, you are representing God. So we have looked at the fundamental qualitative characteristics. Now we're actually going to enhancing qualitative characteristics. How can we enhance qualitative information? How can we enhance it? How can we make a good decision? Yes, we know that this information must be relevant. This information must be free from error and all that. Today I had an opportunity. I was speaking to over 30 graduate accountants. I was just showing them how they can quickly, using Excel, quickly prepare the income statement and balance sheet, and how they can use Excel tools to do that quickly. I asked them, we had done a budget and the actuals. So I asked them to explain whether the company is doing fine or what. They were all blinded to what they were seeing. They were only seeing the actual and the budget, and they gave their own reasons. Later on, I said, no. You should have actually questioned this the question that I've given you. You should have brought in, because you cannot only look at the actual and the budget without looking at the prior years. Remember that the budget also has the potential to contain errors. It contains planning and operational errors. And a budget sometimes, it is not objective based on the budget holder's ego. They may put things there just to show that they have a very big budget. They are big people. They are influential. So you cannot come up with a standard assuming that the budget is correct, and whatever you're getting in the actual should be must be compared with the budget. So I said, why don't you bring in the prior years, 3-4 years, bring in the average, check, bring in the industry standard and see whether things are okay. So the question now is that if you are to look at these things, you want to compare, to enhance the qualitative characteristics of this information must be comparable. Ernest, it must be comparable. We should be able to compare this information. Identify similarities or differences between entities, and year on year. This is where we do vertical analysis, we do horizontal analysis, we compare year on year analysis, quarter on quarter analysis, month by month analysis. We even try to remove data noise by looking at the last trading month, TTM, trading 12 months. So we look at this, the last 12 months, the trading 12 months. So we look at all these things to remove what you call data noise. So information that you cannot compare, you will not know whether you're actually doing fine or not. Sorry, guys. So we need to be in a position to compare this financial information to see whether we're actually doing a good job, and we have to make a decision based on these comparisons. Even just you as individuals, you compare your performance against your current performance against last year's performance, the errors you made, the social errors you are making last year, you compare, you say, now I've changed. And now because now I've become a Christian, I've changed. I'm no longer doing all these other things. You are comparing. Yeah. So it must be, that's how you can enhance the qualitative characteristics of this information. Or you compare yourself to John or to Mary. You see what I mean? So it's information must be comparable, in short. This information must be verifiable. So verifiability of information is key, because you don't want to have information which its sources are doubtful. You can't even trace where the information is coming from that you're using to make a decision. So it assures the information represents economic phenomena it represents. Timeliness. Information must come at the right time so that you make qualitative decision. So information is less useful the longer it takes to report. This is why they advise that the annual report or financial statements are issued 3 months, within 3 months after the following year. So if you are looking at the 2020 financials, they should be issued before March 2021, because we are looking at this timeliness issue. Understandability. This information must not be, accounting information must not be calculus, so to say. Ambiguous. It should be very simple to understand so that a user has a reasonable knowledge of business and activities. That is how you can enhance the qualitative characteristics of accounting information. Is it okay, Sidin?
Great, great. We are getting there.
Sure, thank you. So now we go to the elements of financial statements. Just give you about, I get back. So now we look at the elements of financial statements. I know you know about the assets. Under the assets, it basically looks at 3 things. We know, even when you're defining an asset, we know that an asset, 1, you should have control. There should be an owner to that asset. It does not necessarily mean that there should be a title deed. It doesn't necessarily mean that, but you should have control. You look at past events, inflow of those benefits. So there's something that you are expecting from your assets. You are actually expecting economic benefits, and they call it, under the standard, they say probable economic benefits. Why do they say probable economic benefits? Because it's doubtful. You might not actually get those economic benefits. Liabilities, you know what is their present obligations, past events, outflow of benefits, because you are paying. You have your equity, the income and expenses, that is where you get your profits. Whatever profits that you have, it goes directly into under your equity as retained earnings. And by definition, we know that profit is excess income over expenditure, and losses is a vice versa of that definition or explanation. Recognition. How do we recognize this? So I'm saying probable future economic benefits, the inflow of economic benefits to entity is probable. We should be able to measure these particular costs or assets reliably, but we have to look at the issue of how we de-recognize these assets, liabilities, and all that. These are the things that now we'll be looking at as we go into specific standards, Ernest. Sidney has dropped off, I don't know why. We'll be looking at issues of measurements. We should be able to measure, because what goes into the balance sheet or income statement with all these financial statements, it is monetary. We should be able to measure it. So this is why we look at historical costs. This is a measurement basis most commonly used today, measured at nominal or original cost. We'll be looking at current costs, realizable value, present value. These are things that, as we move on, we'll appreciate more. We have capital maintenance, where we look at the financial capital maintenance, operating capital maintenance, which we'll definitely go into details. So other than the conceptual framework, Ernest, I know Sidney will still be able to have access to the video. We need to look at the regulatory framework, the need for regulation. These standards, they are not just provided or issued in space or for the universe. It is for space, it's for the countries within this planet Earth. So there should be regulation. So there should be regulatory framework for the preparation of financial statements, and it is necessary for a number of reasons, Tim. One, to ensure that the needs of the users of financial statements are met with at least a basic minimum of information. So it now looks at the needs of the users. Secondly, to ensure that all the information provided in the relevant economic arena is both comparable and consistent. Are we able to compare this information? Is it consistent? So that has to be looked at. Here, given the growth in multinational companies and global investments, this arena is an increasing international one. To increase users' confidence in the financial reporting processes, this is why regulations have to be there. And to regulate the behavior of companies and directors towards their investors. So they're very key. So the national regulatory frameworks for financial reporting. Here we are saying there are many elements to the regulatory environment of accounting. A typical regulatory structure includes Sidney, you had a problem with the internet.
Yes, but I'm back in business.
Okay, it's okay. But once we are done, I'll even post this lecture on YouTube, so you have access to it. Those components that you have missed. I can't hear you. You're on mute. I can't still hear you.
Especially the assets.
Yeah, yeah.
But yeah,
Okay.
okay.
Don't worry. You'll all be there.
Okay.
So there are many elements to the regulatory environment of accounting. A typical regulatory structure includes one, the National Financial Reporting Standards. I guess, Zik, at some point, at Zambia, we had our own standards. We used to call them Z7, Z what, but they were just a copy and paste of what was found under what was under IASB. So,
Yeah.
so we decided just to use the International Accounting Standards. I think that was very smart. Yeah. But there are some countries that still have their own national financial reporting standards. But trust me, they are just a copy and paste of these international accounting standards. Then the national law. So national law actually supersedes the reporting standards, because once a law has been set in that country, then it kind of becomes superior to the other standards. Market regulations, these are regulations that will be determined maybe by stock exchange, Lusaka Stock Exchange and all that. So they can actually affect your financial reporting. So the security exchange rules. So all these they have a strong effect on how you report as a company. So basically, this is just a pictorial impression of how these standards are created, where they report to and all that. So there's the IFRS Foundation. This one appoints members to IFRS Interpretation Committee and to IFRS Advisory Council with a to and fro relationship reporting to IASB. So you can see that it's to and fro, appoints overview and govern fund and all that. So the IFRS Interpretation Committee, obviously, even just from the name of their committee, you can see that these are the guys that do the interpretation of the standards and send their data or findings to IASB, International Accounting Standards Board, of which then they prepare and issue these IFRS standards. So this is how these standards are actually issued. So you need to master this particular pictorial expression so that when you go in the exam, you can just draw it or just speak through it. So we end here. Like I said, we have no time. Tomorrow we'll start group accounts.
Great.
Yeah, so I hope hopefully by Saturday we'll be done with the group accounts. I know to be a marathon, but if we can be done on Saturday, Sunday we can look at the questions just to give us the confidence. Then we can then now go into group cash flows. There's what I always say that you have to check out. In checking out, if you go to a lodge or hotel, you don't just start off, you leave the keys. You have to go to the reception, get shamed and all that. Go to the reception, leave the keys. And sometimes the receptionist will give you a form which you have to fill in to say how your stay was. So can you tell me about what you have learned? What is your feeling about this sitting?
Very exciting, actually. The way you have summarized it, especially the conceptual framework, because it's so voluminous to a point where even when you are just following, you reach a point where even you feel this is too much work. But I see the summary, and to me, these are many areas that it's like you have summarized the whole financial reporting. Yeah, to me, that's what I see. It's like the foundation of all the key components that we are going forward. And I'm able now to see what it means when we are talking about these standards, these financial reports, what should constitute a financial accounting information, good accounting information. I understand why sometimes even when you present certain things, donors just say, you know. So, but if the components that are there, I feel more confident now. And also the issue of going concern, the hospital example. Yes, yeah. It gives me some kind of head ups, because sometimes they'll say, is this a going concept? So if you have already an understanding of what a going concern is, it's very easy, because even the examples that you were giving us, they are arriving home. Okay.
Nicely.
Yeah. Yes, they are arriving home. It makes more sense. Even the faithful information that you talked about, where it shouldn't be biased, it should be, it should be free from error and the like. I feel I am getting there. The motivation is high.
Yeah,
I don't know from my place.
Yeah, Ernest. Yeah, Ernest, you have been too quiet. Can you unmute and tell us something? Ernest. Ernest maybe is in a very noisy place. Okay, we'll forgive him for now. But next time, please make sure that you unmute and we hear from you. So we'll use the same link number. That the password obviously is the passcode is my phone number. I don't know if you have observed that. Then the first one. So that is what we'll be using through and through.
Okay.
So tomorrow I think we'll start about the same time. Once you knock off, after knocking off, then we can actually look at that. So tomorrow, before we go into group accounts, we'll look at the practical audited financial statements. Or download a number of them from different companies, just to check what is there, what on ongoing concern, what is it? We see for ourselves from the financial statements.
Yeah.
On the fundamental characteristics of good information, what Ernest is calling. Hello, yes, Ernest.
Yeah, I've just been having challenges on how to speak and where to ask. But whatever as my colleague has said, you have summarized it. This is making we're getting there.
Okay, that's very good. That's very encouraging. You can just tell your friends from different, I know you're in Kasama, you can tell your friends who are actually mostly in the rural part of this country, who may not have access to good lecturers, just if they can also just join in, because you'll be writing in June, so that you guys, you have a very good group. At your level now, you don't need to go and sit in class with boys and girls that are just coming from your homes and learning with them. So you need to find a smarter way of doing it. Sure.
Yes,
yeah.
I think the going concern will be remembering the hospital issue.
Yeah. Definitely. You have to memory peg with that. Sure. Okay. Okay, thanks so much. Yeah. So tomorrow, guys, let's just meet and we'll move on. It will be quite
And you said I go to YouTube. Wait a minute before you sign off, sir. I need to go to YouTube.
Search for my name, Fitzpatrick Kapepe, then subscribe. So yeah, subscribe and hit the notification button. Each time I post new things, new stuff, there, new content, you will have access to them.
I see.
So this lecture will be posted on YouTube just in the next 20 minutes.
Oh, great.
Thank you so much, and bye-bye. Please visit our website and subscribe to our website as well.
Sure.
Thank you so much, and bye-bye.
Bye.